Hey guys, this is Tagene Brown-McBean of Money Coaching Services, and today we are going to talk about 8 ways life insurance can provide financial protection. Alright, so before we get into the details, subscribe, hit the notification bell so that you know when we are on. And there are some information in the description. Check that out because it will be very helpful to you. So we want you to practice what we teach you so you can improve your money management. So we are talking about finance. We're talking about finance as it relates to life insurance. So number one, life insurance provides financial protection for funeral expenses. Yes, I know some of you people talking about, oh, I don't want to talk about that. We are talking about money and dying today. So financial expenses come up when persons die. You have to think about what the funeral cost is going to be like. So instead of incurring those expenses, a better way would be for you to pay a small premium per month with a life insurance policy and kind of do an estimation of how much you think the funeral costs would be like, and you work towards that. It's a much easier way to do it. It's less stress for you, especially for persons who are not good saving, right? And some of you like when the money is just taken from your account and you don't have to think about it. So one protection you get from life insurance is to pay for funeral expenses. That's number one. Number two, family income. Yes, family income. Remember, you have cases where family members are getting income, and whether it is one person in the family earning the income or two persons in the family earning the income, the family depends on whosoever is there. So say example, the one person earning the income, if that one person dies, the rest of the family still need money to buy things. So this is what we call family income. So what that person would do, the main breadwinner, you would set up a life insurance policy to cover you. Well, in the insurance industry, they suggest 150 months. So say for example, you think your family is going to need 100,000 per month. 100,000 times 150 months is $15 million. So that's how they come up to the family income when they are calculating it in insurance, right? Now you don't necessarily have to use that benchmark, but it's just a guide to give you an idea of how to come up with the figure that you would need to cover as family income, how much million you're gonna need, and take the life insurance for that amount. So in this case, you take the life insurance for 15 million because you want the family to have access to 100,000 for 150 months, which is equivalent to 12 and a half years. All right, the other thing is that you want financial protection for education fund. Yes, there are cases where parents have passed away, and because they passed away when their children were young, the child is disadvantaged because of the loss of the parent, not only with the everyday expenses not being paid, but also with something as important as well as their education going up to the level of university. Because we all know that the more education you have, or the more you learn areas that pay a high income, the better off financially you will be. So education fund is very important, guys. This is number 3. So you can set up life insurance to protect your kids, so that if you pass away for any reason, that there is money set aside for their university. So wherever level they are at now, if they're at infant school, so you calculate how much from infant school to primary school to high school to university, what that cost would look like. And it's just an estimation. And say you come up with $5 million as the amount that you think would cover all of the expenses for the education fund. You would now go to your insurance agent and say, okay, I need $5 million of life insurance, and how much will the premium be for me to set up this $5 million life insurance? So if I pass away, my kids get to go to university and the money is there. All right, number 4, retirement income. Yes, a lot of people, you keep forgetting, in finance you have to think about retirement. Now, retirement income can come from a life insurance policy that has cash values. What that means is that it has to be a whole life policy which accumulates cash values over time, and you can work with your insurance agent to say, okay, what amount you think you would be working towards as it relates to your retirement income, because you don't want to depend only on the retirement fund that you have from work. You also want to have an additional retirement income that is separate and apart from what you have at work, because it's best to have more money than you actually need. That is my motto. Have more money than you actually need, so that if anything happens, at least you have a little extra put aside. All right. So with having a whole life insurance, when you reach to the age of 65, say you're gonna retire at 65, then you would draw the cash values from the whole life insurance and put it on what is known as an annuity. Annuity is a payment system that the insurance use, and the annuity is determined how you want it. So you determine it by the amount or by the years. So let me explain. By the years means you say to the insurance company, I want to be able to access retirement income for the next 20 years. So if it's 20 million that is there as the retirement fund on this policy, the cash values, then divide that 20 million by the 20 years, so that every month I get a certain amount, right? So that is how it works. If the other side is now, if it's by the amount, so say also for the 20 million, you say to the insurance company, I want to be able to get 200,000 per month every month from this. The only difference with the amount, using the amount like the 200,000, is that it's the most significant part of it is specifying what you want. You want it, if you want a specific amount, then the specific amount is going to go until that 20 million has been used up, right? The other way, you asking to get this amount for all of 20 years, the 20 million to be broken down in a monthly portion for 20 years, you might end up with different amounts each month slightly. It won't be a fixed amount, but you need to determine whether you want to do it by the years or by the amount. So that is how the annuity works for basic understanding. All right, so number 5, mortgage redemption. A lot of persons have taken mortgages, and some people, they say, oh, I don't have to pay it off till 25 years because it's 25 years they've told me. No, nobody knows when you're going to pass away. So you might take a mortgage, and in the first 5 years you pass away, and the family has this big burden because nobody expects you to pass away so soon after taking the mortgage. Now, because this is a big shock to the family, it is very difficult for them to be able to replace the income that you were getting plus pay for the mortgage, especially if you, the person who passed away, were the one paying the mortgage. So having this mortgage redemption, meaning you say, okay, the value of the mortgage is 9 million. So I'm going to take out an life insurance for $9 million. So if I pass away, the insurance company is going to pay my family $9 million to cover the cost of the mortgage, right? So the $9 million would be paid out like in a check to your family, whoever you have named as a beneficiary, and they can use that money to pay off the mortgage. Less stress. Okay, so number 6 is emergency fund. Emergency fund is 6 months of your expenses, right? Some people say 3 to 6 months, but the higher you can go, the better, right? Some people go as far as 12 months, but you don't necessarily have to pass 12 months of your expenses being saved as emergency fund. You can use the money in a more efficient way than that to basically get some form of earnings on it. But an emergency fund is for protection. It is for when things just pop up. And as you know, things keep changing in life. So an emergency fund is a good way to be able to pay for these things that you never planned for, without you having to run to the bank and pay this high interest rate for loans. Now, you can take out a life insurance policy for emergency fund. So an emergency fund is something that you'd want to have while you're still living. So you take out a whole life insurance to cover the emergency fund, so that it will also be able to accumulate cash values over the period, right? The age, your insurance agent will work out based on your age, if you're a smoker or non-smoker, how much the premiums will be monthly for you to do that. All right, number 7, estate duties. Now, a lot of people don't have a clue what estate duties is. Estate duties, in a nutshell, is the amount that is going to be due from your estate to the government when you pass away. So if you have a house, you have a car, you have a boat, anything you have that is an asset that has a title and your name on it, say John is your name, sorry all the Johns out there, John is your name, and John, you pass away, your name has to come off all those titles, and the government is going to charge the estate an amount based on the value of each asset, right? And this amount has to be paid before the rest of the family get anything. So there are cases where persons have paid like mortgage redemption, meaning they have paid insurance to ensure that if they pass away, that the children can get the house because the money is there to pay off the mortgage, but the estate duties is still there. And until the estate duties have been paid, the mortgage, if in the situation the house, the persons wanted to sell the house, they didn't want to keep the house, then the estate duties is going to be a problem, because if you don't pay the estate duties, the government is going to come in, and this is what caused all of these estate to take so long to process. It is so annoying and stressful for people when they have persons who've passed away to be thinking about something like this. So here is us giving you a heads up to say, listen, go and Google estate duties. Go and call the agent. Go and call a lawyer. Go and call who else? Probably our accountant, and ask them, what is this estate duties I keep hearing about, and who can calculate mine, so that I know that if I pass away tomorrow, that my assets are okay and my family can get them without having to stress or having to sell them parts of them body, them hand and them foot, to be able to get the assets that I've left back for them, right? So estate duties is a big deal, right? You need that financial protection, and you can use life insurance to do that. But first you need to know how much will be the estate duties on your assets. And as your assets increase in value, you will need to set aside more funds for estate duties. Number 8, this is the last one, insurance on a business owner. So some of you guys are business owners. You've started your own business. Business is going well. All right, up to COVID, business was going well, but you're still hanging in there. But what happens is that in most cases, when business owners die, the knowledge of the business goes with the business owners, because some business owners, they don't train their staff, they don't make plans for succession planning. What that means is that who is going to fill my space if I pass away, you understand? And interview the family to say, okay, John, are you going to be the head of the company if I pass away? Are you interested? Do I need to train you? Who else in the family do I need to train, right? These are the business owners, especially the small business owners. And when the business owner dies, a lot of the time the skill, the experience goes with that business owner. And many cases, the business also dies. So you lose the business owner, so the family not getting any income from the business owner, and the staff not getting any income because the business not saying anything. So there is no protection. So now for business owners, there is some protection that can be given to the business. So you take out an insurance to protect the business, right? Because when the business owner dies and everything starts falling apart, the banks are not going to lend anybody any money, right? The creditors are going to swoop down on you like a hawk. So having this money to protect the business and to make it stable, like for 5 years, having money that you think that you can assess the business and see how much money it will need to run for another 5 years, after the business owner has died, right? And you use the life insurance as a policy for that purpose. Now you also need life insurance where you have life insurance on the life of the business owner, where you pay the family, because the family is going to say, okay, Stanley was the head of the business and we weren't getting income. Now Stanley died, so the business owe us money, or we are coming into the business to run the business so that we can get money. And you don't want that, because most times the family members that are out there, they've never been in the business, they don't have any expertise. It's best if you just sit down, make a plan and say, okay family, we're drafting up 20 million for you, so that when Stanley dies, you're gonna get your 20 million and you leave the people them that are now in charge of the business alone. You leave the business alone, right? So everybody is happy. So here are my 8 ways life insurance provides financial protection. Now you can put in the comments if you have any other suggestion that you think our subscribers can benefit from. But thank you, and if you have time, see you in the next video. Okay guys, bye.